Hello, everybody. So, 2 p.m. I'm very excited to be with you today. Thanks to CFO Connect Summit to set up this session. So, I'm Antoine. I'm a partner at Acting, a part-time CFO boutique. We operate in France with 4 offices and in the US. We work, for example, for scale-ups such as Talent, now listed in NASDAQ, and more recently, we were the CFO of Agicap, who raised 100 million USD. We have the chance to be with 2 professionals with impressive track records, Niels Boon and David Morera. Niels is a former consultant turning entrepreneur through different scale-up experience. He's now CFO of GenJob, and David is a finance leader with experience in large corporate, then turning also entrepreneur in several scale-up. He's now CFO of Motesk. So we are going to speak about cash flow management in hypergrowth. But before going further, I would like Niels and David to introduce themselves. So Niels, stage is yours.
Thanks, Antoine, and welcome everyone. So I'm Niels. I'm Dutch from origin. I'm living in Berlin for about almost 10 years right now. Like Antoine mentioned, I started out in consulting first at McKinsey. And then I came to Berlin for Zalando when I was still quite a young, small company, kind of unknown company as well back then, 2012. And since then, I've been CFO at different tech companies based out of Berlin, but always operating internationally throughout Europe, but also beyond. And currently, I'm CFO at GenJob. David?
Thanks, Neil. And I'm really happy to be with you all today. And a little bit about my background. I'm currently the CFO of Motesk, as Antoine said very well. And before Motesk, I worked in Berlin for Audible, where I was the FP&A director for European region. Before Audible, I worked for Zalando, where I was orchestrating the group investments in infrastructure and technology. And before Zalando, I worked based in Prague and helping small startups to scale and growth across Central and European region. In between, I did a PhD in finance, and as I'm passionate about the technology, I also already finished a computer science certificate from Harvard. So very happy to be with these 2 gentlemen today and to share our experiences from the past.
Okay. Thank you to both of you. So maybe to begin, I'm quite curious, and I have some questions to both of you. Niels, you were at Zalando between 2012 and 2013, 1 year before the IPO. David, you were also at Zalando, but later, at a later stage between 2017 and 2019, and the company was then listed. So please speak about your experience then, and so from your perspective, what was different in respect of cash management? Maybe we can begin by Niels, who were earlier in the company.
Yes, that makes sense. Thanks. It's a good question indeed. So when I came, I started as head of strategic finance. It was kind of a new team made up. It was just me in the beginning, and then afterwards about 9 people. And my focus was first on profitability management, and then also on working capital management / cash management, of course, which is kind of almost the same. I think when I came, there was kind of nothing in place. So the main focus was just on growth. It was only about getting brand recognition everywhere. The aim was, I think, 97% or 99% that Zalando should be top of mind in all the countries. And if you pay enough, you can probably get there with a lot of TV campaigns and stuff like that. So I was focusing first on profitability management, making sure that from an EBITDA perspective, we would become more profitable, and then setting like the benchmarks and tracking the right KPIs, etc. But then soon it moved to working capital management, because that was way more interesting and big at the time, and even more neglected. So sometimes we had swings of like 100 million just from 1 month to the next, because like the winter was taking 2 weeks longer than expected, or there was something not working with discounts in a certain country or stuff like that. Yeah, so quite interesting to set it up from scratch to define what is working capital. So accounts receivable, payables, and the inventories, and then go deep in all of those groups to understand like what is the current situation. That was already kind of unknown. And then also how can we improve and what should be a benchmark for all of those. And of course, since then it has stayed quite important. And I can imagine that David also worked with this later on, a couple of years later than me at Zalando. So maybe you want to take it over.
Yeah, thanks, Neil. That's really interesting what you just said, because when I came a few years later, so I worked at Zalando between 2017 and 19, also within the central functions, central controlling. And we had already a slightly different picture of our cash management by then. So I was responsible for the competence center of investment controlling, which meant that we were responsible for the planning and orchestration of all cash flows related to fixed and intangible assets, where were included also the cash flows related to those. So initially, that was my scope, and well, this is public information. By then, our budget for investments was about 500 million euros a year, and the company was having a top line revenue of about 6 billion, and we were planning and discussing by then how could we achieve 12 billion euros by now after a few years. And for us, back then it was really something hard to achieve, but now we can see that actually Zalando overachieved that target. So going back to the cash flows, so it was really important that we had strong liquidity, and as well that we were able to invest where the projects and initiatives were paying the highest returns. And that's basically one of the main responsibilities that I had together with the overall planning. At the end of my tenure at Zalando, I stepped into the also competence center of working capital management that Niels probably built up a few years back. And that was when I also had opportunity to look into the operational cash flows, where all the payables, receivables, and the inventory management were being dealt with. Antoine, back to you.
Okay, thank you. So we talk about working capital, about profitability. So in order to focus on profitability, I would like to speak about how we could secure cash in a hyper growth context. So do you think that we can manage cash through spending smarter? And so to which extent new tools offered now by the market can help the CFO in this context, in this objective? Niels, maybe first.
Yes, thanks. Yeah, I think it's always interesting to know like what does spending smarter mean, right? So sometimes you're actually not spending enough. So it depends a bit on the mandate, I guess, that you have from the investors, and also the stage of the company that you're at. Having said that, there's always, of course, a budget, or there's typically a budget in place to which you should live up to. And then, of course, these days are a lot of additional tools that were not there in the past. For example, Spendesk, of course, I have to mention. It's a great way of tracking your expenses, but there are different names out there as well. And or also, for example, AkiCap, what you mentioned before, that you're familiar with, to track your expenses in real life and your cash in real life. This is really useful, and that wasn't available like that, I think, a couple of years back. So this is really helpful, so you can see in real life how it is going. Typically, of course, you have two big items as a tech company in terms of spending. It's on the one hand, it's like the marketing, like online marketing spend, and second, it's people, so the hiring. So therefore, to go deep into those two, that's also useful. So you can track, for example, online marketing spend also directly, of course, in dashboards, or for example, we're using Tableau, but I've also used other tools similar, for example, called Chart.io. I mentioned AgiCap before. I see there's one question from Alexandra. This is a cash flow tracking tool. But yeah, so you have different tools nowadays that make it easier to sit on top of it. But at the same time, there's a risk that you know too much because there's too much data available. And also you can kind of drown in the details. So you need to kind of delegate and let go under a certain level, because otherwise you might get crazy from it. But yeah, also this depends on the stage of your company. So when you're still small, like let's say Series A, you probably know more or less everything as a CFO anyway. When it gets bigger, you don't want to know everything because it's just too much, and then it means you're not doing your real job, let's say. So you need to delegate and give budgets and then manage, I don't know, once per month, for example, whether those people are within their budget or not. Want to add something, David? Or?
Yeah, that's a very good question, how to spend smarter. And that brings me always to the thought that it's all about one of the fundamental decisions that every business has to make, that is exactly the investment decision, how to allocate the scarce resources and funds for competing uses. And what does it mean? It means that companies have to decide where to double down investments, where it's paying the highest returns first, and secondly, how to control it afterwards. And to that, I'd like to give, for example, one experience that I had, one real case experience that I had in Audible, where, for example, all the resources were being planned and allocated accordingly after being approved. And then every time that each of the areas of the company would like to execute the budget that was allocated, that had to go again through, let's say, a very transparent reapproval process. And that meant that the company had a strong grip on the expenditures. In the case of Zalando, as I was also responsible for not only the planning of investment, but also its approval, at least for the last investments, we created a very innovative platform just for approval of large investments, dealing together and creating it together with leaders across different verticals and business units, so we could create a full, transparent, and seamless process for the investments for the approval of those investments. So with that, I think both, wrapping it up, to spend smarter, it's all about choosing and selecting the right area where you allocate your scarce resources and how to control them afterwards.
Okay, thank you very much, David. So another question, please. So before accelerating so fast, like Zalando, most of entrepreneurs focus on the cash burn, on the cash runway, and you were talking about budgeting and so on. But from your perspective, what are the best KPIs to follow in the context of cash management? Maybe David first.
Yeah, sure. So in our case, we were back then focused on four main overall KPIs. That was the top line revenue or GMV, the profitability or net income, and then the working capital ratio as of percentage of revenue, and also the investment level also as of percentage of revenue. So those were the main KPIs that were steering the company and that were being communicated in all external official reports. So specifically talking about the cash flow KPIs. So it depends on the three main areas of cash flow management that we could talk about. The first one are the operation cash flows, the second, the investment cash flows, and the third, the financing cash flows. Regarding the operational cash flows, and talking about working capital, a good example I could name now is at Zalando, where we always try to have close to zero, negative working capital, but slightly below zero. And that was the best KPI that we thought that could help us to steer efficiently our operational cash flows. In regards of KPIs to our investment related cash flows. So we were basically looking at two main areas of spend, infrastructure and technology. In regards to infrastructure, the investments were mainly dedicated to large supply chain investments such as warehouses, robotics, and related infrastructure. So what was really important was that these investments will serve the business ahead in time, meaning we were planning ahead 1, 2, 3 years to make sure that these investments will serve the business as it was growing so fast. In related to the technology, it was all about to understand if the software teams were producing software that was in fact capitalizable and valuable for the company. And that was how we were evaluating their worthiness. And regarding the investment cash flow, so back then we had 1 billion euros in liquidity. Now it grew because it's also public information, as the capital markets also serve this purpose recently, because the company also has a different overall growth volume. So those were the 3 main areas and the KPIs that we were looking at across each of them.
Okay. Niels, do you want to add something regarding the KPIs and cash management?
Yeah, I think also here it depends again on your stage and business model. One important one I would mention is CLV over CAC, so the customer lifetime value to your customer acquisition cost. This also depends then on your business model, how important it is, but it can be the one and only in the B2C business, but also in B2B too. So I think that's one to always track, and you need to know inside out. Yeah, I think that's a key one to not forget.
Okay, great. Okay, maybe David, I would like to. I have some questions for you. So
yes, sure.
In hypergrowth context, so needs may change rapidly, and you are an FP&A expert, and so I would like to know, how do you handle the forecast? Do you prepare it annually? Do you reforecast, and at what frequency? To which extent is it so important about cash?
Thanks. Excellent question. And I'd like to give the example, the real case example of Maltesk right now. We are in hypergrowth stage, actively working on the next investment round, very successfully, by the way. All the process is going very well. And we are now having the plans of expanding significantly across Europe and the US in terms of not only the tech related teams, but also marketing and sales areas. So with that, of course, we have sometimes ups and downs as everyone in the business, and those require an adjustment in our forecasts. And to that, we have a nearly yearly top-down and bottom-up approach where we align with the strategic team, with the strategic discussions and management teams on the main KPIs that we want to achieve ahead in time, first in 1 year, 2 and 3. And then we allocate this budget across the areas, and we ask also for the feedback, and that's the initial budget. But as we have so many, let's say, externalities during the year, we indeed have to reforecast on a quarterly basis accordingly. And with that, also, to add to this and to your question, we do always, on this reforecast, scenario planning. We always have the current scenario, the worst case scenario, and the best case scenario. And also when it's needed, for example, for investment rounds purposes, we also, on the top of our current scenario planning, we also do what we call the what if scenario. That it's what about if we receive X amount of investment additionally, where can we grow faster? Where can we expand first? And do this prioritization also in this what if scenario according to future investment rounds levels. And that's how we do it.
Okay, thank you very much. And I would like also to know, David, is it important to your opinion to comply with the budget? Yeah, what is the trade-off between underspend or overspend? What do you think about that?
In my case, for me, it's fundamental to comply with the budget, and I always have a very strong grip on that. But for me, controlling the budget is not only looking at overspend, but also looking at opportunities. Because honestly, if we see that some areas of the business are overspending, but in fact they are bringing more value to the company, the value drivers that they are having for this overspend are really meaningful, and they will bring more returns in the future. So in that case, overspending is a good thing, and we definitely, as finance executives, have to find ways of how to allocate more cash to these business opportunities.
Okay, thank you very much. So maybe now a question for Niels. So up to Series B, cash is a scarce, rare resource. You need to really pay attention. So in hypergrowth, does that change? Are there different contexts of hypergrowth?
Yeah, so it's more about being before or after the round, I would say. So assuming that you just closed the round and your bank account is full, then of course you need to spend as quickly as you can. That sounds a bit counterintuitive, but I mean, you will never reach the budget that you gave probably to the investor otherwise, right? So you have to go quick in terms of hiring, typically, and this is always taking longer than you think. So you have to set up the right processes to make sure that you will actually be able to hire those people, who will then make sure that you can hopefully reach the targets that you set out. So there the focus would be more to relax a little bit, I think, the control over the budget itself, and you might spill some water over the edge sometimes here and there, but this is like how it should be. If you want to really scale quickly, and for example, you kind of move maybe into different countries at the same time, you do it as good as you can, but of course, yeah, you might make some mistakes here and there, or wrong hiring, or an expensive lawyer that is going to be too expensive, but you already started with them, so you don't go back anymore, and you just finish it and deal with the bill later. Or with system setups, you just want to start, and then you find out later that maybe this accounting system doesn't work with your group one, or some other smaller things that are annoying, but not a deal blocker when you're focusing on hypergrowth. And the most important thing is that you always keep track of also like your unit economics, that they are still good and still working well, because typically when you start spending more, your ratios deteriorate. So if I go back to the CLV CAC example that I had before, so the customer acquisition costs typically first become worse, so they become more expensive when you start scaling, because when it's B2C, you spend more on online marketing, for example, and the channels get crowded. So your costs are going up. On the B2B side, you would have to hire a sales team, account managers, etc. You have to find them, hire them, then they sit in their place, but it takes 6 months until they first have like some real clients coming in. So you have some lead time there, and that means that your ratios will first worsen a little. But the question is, of course, is that then a permanent thing, or do you trust that it is improving? So you still need to watch it carefully, of course. But yeah, so I think that's different from before a round, so before the hypergrowth round, let's say. Of course, you can have organic hypergrowth as well, just because people love your product and they buy a lot from you, and then you're kind of self-financed from your own profitability. Hopefully, that's good. I was assuming here that it's because of funding coming in, and then you need to grow even faster. So of course, you already grow to get the funding, but then you can go even faster, hopefully. You're on mute, Antoine.
Yeah, thank you very much. Yeah. So we are talking about fundraising, and so I have a question about of debt. Is it necessary to lever on debt, and if so, when? What is your experience in this respect?
Yeah, so this is definitely an interesting option as well to look at that, and not just at equity financing, because in the end, equity is the most expensive way of financing, and also it takes the most time, and it's the most annoying because you have to get so many approvals and maybe like go to the notary, depending on your country, of course. So yeah, definitely looking at alternative financing like that would be interesting. However, it depends on your stage of the company as well. So if you are like early stage and you don't have profitability yet, it's already ruling out a lot of potential debt providers. You don't necessarily have to be profitable these days, but at least you have to be unit economics profitable. So that means at the gross margin level, ideally a bit lower even profitable, and then you could maybe finance that, especially when you have recurring revenues, ideally with locked-in clients who have like yearly contracts, for example, and are quite loyal. Then you can also get financing based on that. And you have nowadays, since I think 1 or 2 years, also a couple of new players in the market who offer specific financing for just, for example, customer acquisition costs for online marketing spend. So you can finance just that part, for example, or inventory financing or receivables financing, or all those things from working capital can also be financed in itself. But everything comes at a price, of course. But like I said in the beginning, all those prices are typically cheaper than equity. So it's definitely worth considering it.
Okay, thank you very much. Thank you very much. So, David, you worked for different companies, someone making losses, some other profitable. So I have one question. So does the break-even point, for example, change the way a CFO manages his cash? Or are there more important parameters, to your opinion?
Yes, both are important, as you mentioned, but in my opinion, it depends on the maturity stage of each company. So there is not one solution fitting all in that case, but it depends. I can give you the example of one startup that I worked a few years back based in Prague and scaling to the Eastern and European region in the area of e-commerce. So the situation was that the company was scaling really fast. The customer acquisition was dramatic. The traction and demand was growing exponentially. So we saw a great opportunity. But in e-commerce, as more you grow, the more returns you have, the more related expansion expenditures you also have. So we were facing systematic liquidity challenges. And in that case, so what was in our mind? So should we slow down the growth rates in favor of having a better liquidity ratios? Definitely not. In that growth stage, we just wanted to grow as more as possible. And in our mind was just, so if we could grow year over year 2-3 times, how can we grow 5 or 6? That was in fact what was in our mind. So definitely in that early stage, we didn't think at all about break-even points, and no one cared about that basically while we were growing so much, because it was all about customer acquisition, country expansion, and how to maximize the finance liquidity ratios was definitely not on the top of our mind. However, in other companies, and now talking back to today's example, when I am in Motesk, as we are actively in this process of seeking for another investment round, we also have in our projections the expectation when we plan to achieve the break-even point, because we are already with a very good growing curve, so stable with recurring revenues, as we are a SaaS company, or as we call ourselves, DaaS company, data as a service in the field of biomechanics. So we have recurring and stable revenues going forward, and the new accounts coming in. So in our case, we already think about when can we have the break even, so we can have a more successful financing round and give a clear expectations on the profitability path to external investors.
Okay, thank you very much. Thank you very much, David. So maybe for Niels, what are your priorities in the use of proceeds, and how to arrow cash flow between operation needs and corporate needs, such as acquisition, for example?
Yeah, that's an interesting question as well. So generally, with tech companies and high growth situations, you're short of people, and that is often tech people. So anyone who can build more of the product, right, or build new features or something like that. So anything you can do to speed this up, that would definitely be interesting. And therefore, looking at acquisitions to buy a certain company somewhere, that would be definitely an interesting option, of course, especially if you want to look at, for example, either going to new countries where you are not present yet, and otherwise you would have to start from scratch and building everything up, finding local people, etc. You might get a head start by acquiring a team right away, or to do some kind of tech acquisition where you more or less buy a product and that you can integrate with yourself, with your existing main product. That could also be quite interesting. Or to take a competitor out, for example, like a smaller player who is just annoying you too much. You might as well merge them into you if that's possible. So you can focus on other things instead of fighting each other in your home market. So I would definitely recommend looking at acquisitions. But having said that, it's also tricky. You cannot depend on them because, like, I think 2/3 of acquisitions turn out to be unsuccessful, and this is out of the 100% of the acquisitions that took place, right? So there's probably like only 5% or something successful from things you're looking at. So you have to be really sure why you're pursuing a certain acquisition. Is it for X, Y, Z? And then under that hypothesis, pay only the price for that. So if you just buy the tech, you shouldn't pay for the clients or the revenues, for example. If you want to just grow your revenue base, then you can look at revenues, but you look less at other things maybe. So yeah, it's a nice way to go quicker, but it's also a risky one.
Yeah, okay, thank you very much. Maybe another question. So regarding the relationship you may have with your board in a high growth context and the consequences it may have on the cash management. So at some point, were you pressured by your board to burn your cash faster? And if so, how did you handle it?
Yes, I've definitely got that question a lot in the past at different companies. So to go faster because you want to grow faster, right? So you want to do more revenues, or you want to develop your second product faster, or you want to go to another country faster. So for this, the question always comes, can you not go faster? Can you not spend more? Can you not just do way more marketing spend, for example? And of course, this is always under the assumption that you will do it in the right way, right? So not just more, but also more while keeping the same profitability levels. So if you then start spending just more, but profitability goes down, then the next board meeting, they will say the opposite, the exact same people. So I've seen that as well, of course, happening, that people can change their mind overnight on the same topic. But yeah, it's always good to show like where you are investing and why, and also what the hypothesis is. So for example, you're opening a new country. Is that to prove an MVP? Like you want to prove that you can actually generate revenues outside of your home market? Or is it because you really want to grow there? And that's a different starting point, of course. And then you go about it in a different way. So if it's a more permanent thing and you know for sure you want to grow there, then you do everything from the bottom up in the right way, or you try to as much as possible. Whereas if it's just to prove that you could go there, then you say, okay, we can do some light touch here. We can outsource this element there. The product is not entirely ready, but it's good enough for now. Let's see if we can work with 5 clients. Then later we can fix it retrospectively. So as long as you're open about what you're doing and why, and then hopefully the budget and the cost also kind of correspond to that story, then you should be good.
Okay, great. Maybe David, I would like to ask you a question about the work of CFO. So sometimes it's a play between day-to-day management, and that above all it's more about long-term directions. And so how you manage your cash to get to your next round of fundraising?
Understood. So my first goal, talking about the goals of myself as a CFO, is primarily really to translate the CEO strategy and the board strategy into executable financial measures. And that includes everything related to all strategic decisions that will affect the present and future of the company's success, as well as all the traditional responsibilities of a finance position, executive finance position, such as planning and controlling and investor relations. In that point of the question that you just made, how do we manage effectively then the cash accordingly? So We have a long-term plan and a short-term management on this plan, where we have there clear outline our promises in terms of new countries to enter, in terms of new customer acquisitions, in terms of quantity and quality and volume of each customers. We are a B2B SaaS company, as well as the levels of cash that we have to execute our budget efficiently. So we have on a monthly basis reviews with the tech teams, with the management team, with the sales team, with the marketing teams, where we review one by one what were their main initiatives, how much was spent against the plan, and if there is an opportunity also to spend more. So it's a forum where everyone can speak up and share their own views. So we do that across all the teams, and everyone is involved and in this process. And we have a transparent communication of our achievements and also areas of improvement that we need to look at in terms of budgeting of cash flows. With that, there are usually not much surprises in our case, because we do that on a regular basis. In addition, if on a weekly or weekly basis we have to come back to the cash management and raise a flag, or even discuss where can we find the external resources, financing resources to take this or that project, we also do that. With that, I think it's all about interdisciplinary communication, have also a transparent way how to communicate results and how to look at opportunities and mitigate overspends on a monthly basis. And with that, there are no surprises at all.
Okay, thank you very much, guys. So it left a little bit less 15 minutes. Maybe I suggest to go to the Q&A part. So we have different kinds of questions. So some about KPIs, some about tools, maybe other about main experiences. Maybe we can go first with some experiences. And I have a question which is primarily, what is your biggest failure in regards of cash flow management? Maybe David or Niels, if you want to.
The biggest fear?
Failure.
Failure.
Give a testimony.
Same. It's the same, fear and failure. But in terms of failures, I always like to revisit them and also at the same time share what did I do to make it better. In that case, I like to share what is on the top of my mind. Many years back, when I was working for this e-commerce company in Prague that was expanding very dramatically and successfully across the region, we were growing so fast that we were not able to generate enough operational cash flow, and we were not able to get enough external funding from investors or from the banking system to face our liquidity shortages, which means that I had often to choose between paying salaries or to pay suppliers. And this was, for me, by then a failure. And together with the management team, we had really strong deep dives and a lot of deep dives on every part of spend in the company to understand how could we mitigate that and have always enough cash to at least meet our short-term debt obligations. And how did we do to solve this? We were a startup. We in the field of online retail, selling, in that case, fashion and apparel. And our, let's say, way that we could have by our hands to steer the systematic liquidity problem, meaning not having money to pay all the short-term debts, was to start really looking deeply on the way that inventories were being managed. Do we have stock for 1 month, or do we have stock for 1 year, or do we have stock actually in some categories for 5 years? Why do we need to have the money, the cash tied up to inventories. We don't need that. We need to improve the way that our products rotate in our inventory to have, for example, in average 3 months max stock in the products that sell the most in our warehouse. So for that, we need to improve the way that we are buying, having a more data-driven approach to the purchase orders, and also a better way and automatic way how to manage the stock in the warehouses. So that, together with a strong plan that we had with capital markets access and even involving fintech parties, we managed to turn a company that was really fast growing and burning more cash than what we were generating into almost profitable company, keeping the growth that we were having at that moment that was really extremely successful. So I think that was a good case that I'd like to share with all of you.
Okay. Niels, do you want to add something, or maybe we can...
Yeah, maybe in general, like the common pitfalls that you have when looking at cash and like what could go wrong. I've seen cases of indeed also stock levels being too high or not being tracked even. So this could go wrong, of course. And then you have also, if you have products with expiry dates, this can be tricky. So you think you have 5 million or whatever are lying in a warehouse, but then if it all expires next month, it's kind of that already, right? And another one is around VAT in different countries. So if you're active everywhere, but you also need to pay VAT everywhere if it's a B2C product. And that's not always on everyone's radar. So then you think you make a lot of revenues, but at some point you will have to register and pay all the VAT back, which is then about 20% of your cash, of course. So yeah, that can also be a big one. And the final one is about exchange rates. When you work with the US, it can move a lot. Also with emerging countries, even more, of course. I work with Brazil, for example, and then we doubled in revenues, but only had 10% growth in euro. So yeah, things like that are something to think about, for sure.
Okay. Maybe we also have some questions regarding cash runway, and did you experience some complicated situation regarding cash runway, and how do you manage communication with the company in this respect?
Yes, that's a very good question. So I think the most important thing for a CFO is to always remain confident. So you just know what's happening, hopefully, as a CFO, and you know that funding will be coming or that you will find a way out. So this is my number one rule, to just stay calm, even though maybe in your head you're not, because there's so many scenarios going on. But yeah, you always have to deal with like a limited runway. And at the same time, you're probably fundraising and you want to spend more so that your numbers look good during the fundraising, but you don't know how long the fundraising will take, right? So I've had many of these situations that a round took longer. It's always like 6 months maximum, 4 to 6 months is always the idea. In reality, I've done anywhere from, I think 4 months can actually happen if you're really well prepared and already in contact with investors, but I've also done up to 2 years around, and then you're kind of getting by with like a bridge loan here and a convertible loan there, and maybe some tricks. You can get the client to pay up front, for example, and then you have another month. So you do that in the background as the CFO, but towards the company, you just have to speak in a normal way, of course, and just pretend everything is normal, because not everyone can handle this information. So yeah, I saw this question of how to balance this with sending negative signals throughout the company, while at the same time you want to make sure that people don't overspend. Yeah, so I think it's not wrong to say you are not profitable yet, because people will probably know anyway, and you're fundraising, and that therefore you are careful about and conscious about your spending, which doesn't mean like we're cutting all over the place because we're dying. That's something else, right? So I would always balance it and say we are still investing in XYZ. However, until the round is closed, we're not gonna launch a new product. We're not gonna do new markets, for example, and we're not gonna hire, I don't know, 50 extra developers who will build something that becomes a product in 2 years.
Okay, thank you very much. We still have about 5 minutes, so I suggest we have maybe 2 more questions. Maybe one about KPIs. So we talk about working capital, and I have one question about DSO. So how are you tracking this KPI? How do you work on this? So I don't know if David or Nils you want to jump in.
Yeah, it's definitely an important one. Here it depends on also again the kind of the business model that you have. So at Zalando, for example, I set this KPI up. So it's the days that your sales is outstanding. For those who don't know, it's how many accounts receivable you have. So outstanding bills, invoices from clients or from consumers as a percentage of your sales, roughly speaking, divided by the number of days. You can do the same with inventory, and you can do the same with payables on the negative side. And then the sum of this is your cash conversion cycle, which is then hopefully 0. You can aim for, like David mentioned before, or negative even would be good. However, like this ratio can be a bit misleading when you have less volume of numbers underneath. So if you have millions of clients going on, then of course this is a good ratio to look at because you cannot check every client individually. But if you have a B2B business model where you have, for example, I don't know, let's say 10 clients outstanding with a bill, you can do this ratio, but you might as well just look at those 10 cases and know them by heart and track them every month and know that one guy was on vacation, the other one is still waiting for confirmation of something. There's always some practical issue. So then you're still tracking this ratio, but without necessarily looking at, it can only be 10 days, for example, or something like that, some hard rules, because it's all specific. But yeah, it's an important one. And there was another question I saw also that's related about as a small company, if you can actually negotiate payment terms from your side to your suppliers.
Yeah, it is one of the questions regarding payment terms negotiations. How maybe the bargain power with suppliers and so on.
Yeah, exactly. So that would be the same kind of ratio, but then in the other direction. It is surprisingly possible, would be my short answer. I think it was Michael asking this question, but so you cannot negotiate with Google and Facebook, of course, like they don't care about you, but with others, just by asking already, the payment terms start increasing. So it's a matter of focus and just trying.
Okay.
Worst case, they don't change it, right? So yeah.
Thank you, Nils. Maybe last question for David, and I think we can't leave this session without talking about cash forecasting tools. So, David, what is your experience about that? Do you foster, for example, new tools like Agicap, or do you have some new tools? What
sure.
is your recommendation?
Excellent. So my recommendation is based on all the different ERP systems that I've been experiencing in different companies. Currently, we basically work in Excel because we are a small startup, scale up, that we need to have fast reforecast and immediately retrieve the information that we need to put in reports in a clear way and share it with the relevant stakeholders. But in case of, for example, Zalando, that I think is one of the best cases that I can name here, we were with when I was there within the transformation to S/4HANA, which included that we could also incorporate in the steering or managing of our cash flows the SAC, that is the SAP Analytics Cloud, which was a really powerful tool that enable all the raw data that was in these ugly SAP systems to be visualized in a very fancy, and as we were calling it, a boardroom way, or to display the right KPIs in the right way in a very attractive also manner. And that is, from my point of view, one of the best examples of digital transformation that I've seen so far.
Okay, thank you very much. So we have less than 1 minute to say goodbye. If you have one recommendation to conclude, I don't know, Nils, in 2 words, and maybe then David.
Sure.
Yeah, so I think in general, it's really important to focus on cash. Like if you have anything to choose, I would start there and then build your way up of understanding how the company works. So just go see what's going in and out each month and take it from there.
David, 10 seconds.
So for me, the really important is to look at investment decision, the financing decision, the growth rate decision, and the exit or dividend decision to have a successful growth story in a company.
Thank you to both of you. Thank you, guys, and thank you for all for attending this session. So we can meet at the networking session after all if you want to meet some people or ask some questions. Thank you very much to all. Bye bye.
Thanks.
Bye.